Malcolm Spittler, he is the Vice President of Investment Strategy at Citi Private Bank. He's joining us on the phone line right now. Malcolm, thanks very much for taking out the time. What did you make? Obviously, this was unexpected lines, but it left the markets wanting more in terms of a future course of action.
I think that's absolutely right, but I think it shouldn't be kind of taken away that we haven't yet actually seen the concrete damage to the U.S. economy that the Fed is responding to. I mean, this is very much putting water on the fire before the fire has even started to kindle in the hard data. Sure, we've seen a downturn in the ISM manufacturing. We've seen slightly softer inflation numbers. But in terms of actual concrete causes for the Fed to cut today, I think this is acting early, and I think we should take the Fed at its word that it will be data dependent. And as we see either the market reacting positively to this support or continuing to deteriorate, it will presumably change its stance accordingly.
Right. Malcolm, one query that comes to mind is that in the Jackson Hole Symposium, we had actually heard some comments suggesting that, the Fed is not responsible for what comes out with regards to the trade war. And, that's independent. Fed rate actions are not to take care of the issues of trade war. And this is exactly what they've been seen quoting with regards to the rate cuts that they have taken now, where they have said that the rate cuts are justified largely because the risks have been raised by Trump's trade war with China.
It's a really difficult balancing act because there's not a concrete science of how much damage you're going to see in the real economy from these very unorthodox trade movements. So the Fed is trying to head off weakness, but it's doing it in a way that is dealing with a great big unknown. And the Fed lives in the world of the unknown. They always are looking at uncertain futures, but this is even more uncertain than usual because trade policy isn't following any kind of rule book that anyone can look back to prior events that are similar.
Most now saying that, the range for rates between 1.75 to 2% will most likely stick for the entire of 2020. Is that something that, the street is factoring in?
I mean, that is definitely the City House call. I mean, I think it's worth pointing out the really bimodal distribution that we've got in the dot plot. There are obviously two separate teams, if you will, with very different views on appropriate policy. We saw that with the three dissents today. And I think that kind of separation allows any kind of change in the data to quickly move one or two voters over and get an overwhelming majority in either direction.